So with the news that the Fed is turning hawkish, inflationary concerns, and the fact that the stock market hit 70 all-time highs last year, is it really the end? Doesn't the stock market always go up? Should we just buy the dip? Or are we headed for more red days? Today, we'll look at the most famous 4 stock market crashes, how they happened, how quickly they're resolved, and what we can learn from our past stock market problems. But before we get into today's video, if you could like and let me know in the comments section what you are concerned about most about investing in the stock market today. All right, so before we begin, let us first at least define or try to define what a crash is. In the US, a crash is determined by a steep drop in the value of market indexes. Now, this is not to be confused with a correction. A correction is just a 10% drop in the stock's price, and this can be anything from an index, a stock, or a particular sector. All right, so the first of our 4 stock market crashes or stock market recessions that we are going to cover today is, of course, 1929's the Great Depression. Now, the Great Depression started on October 24th, 1929, and extended in a panic sell-off through November 13th. The market continued to sell off all the way until July of 1932. During this time period, the Dow Jones actually lost 90% of its value. So what caused the Great Depression? Well, many historians and economists attribute the fact that the stock market crashed due to many folks who thought that investing in the stock market was a no-brainer. It was free money and stocks only go up. Sound familiar? This time period was referred to as the Roaring Twenties, where people would take out an extra mortgage, borrow money from the bank, borrow money from whoever they could find to invest in the stock market. So all in all, they thought, stocks only go up and let's get as many stocks as we can. All right, all joking aside, why did it take so long for the stock market and the economy to recover from the Great Depression? I mean, there's a reason why we call it the Great Depression, right? Unfortunately, the stock market, the Dow Jones Industrial Average, took all the way to November 1954. That's 25 years to get back to its 1929 highs. That's pretty ridiculous. So why did it take so long to recover? 25 years is pretty long. Well, let's see what the Treasury Secretary at the time told the President. Treasury Secretary Andrew Mellon told President Herbert Hoover, "Liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. It'll purge the rottenness out of the system." Yikes! The government at that point took what's called the laissez-faire, which is an economic theory. In French, it pretty much means leave it alone. They just said, well, they'll let the businesses figure it out and leave it up to the free market to decide who becomes successful. Fortunately, Janet Yellen, the Treasury Secretary of today, is a little more helpful. And who can forget Papa Powell? All right, the next crash, and that's going to be 1987, Black Monday. In 1987, the US stock market had been on a bull run for 5 years. And on October 19th, 1987, the Dow Jones Industrial Average sold off 22% or 508 points. And with that, many of the stock markets around the world followed. So what caused this? Well, the first thing was that the Dow Jones Industrial Average was up 3 times in the last 5 years. So many speculated that this perhaps was a top. The bull market was going to come to an end. The second thing that many economists and historians are attributing to the crash is the kind of invention and the adaptation of trading algorithms and programmable trades in addition to portfolio insurance. So let's take the first one first. So software trading is pretty much where you're looking at different indicators, etc., and the fund would automatically initiate a trade without any human intervention. What this did was it caused a cascading or a domino effect of selling once the selling started. So yeah, that happens every day, you know? We got algos all the time. We haven't crashed the stock market yet. Well, these are primarily new inventions in this time in 1987 that on top of portfolio insurance. What's portfolio insurance? Glad you asked. So portfolio insurance is basically a strategy that was created where instead of selling off your positions, you would sell short the futures of the indice. So let's say if you hold a basket of stocks and the stock market's going to go down, you're just going to sell the S&P 500 futures. In doing so, they created another domino effect where by selling of all these futures, the stock market went down, causing the portfolio to execute automatic trades to keep selling. Now, because this crash was predominantly caused by software, the Fed stepped in and they were able to kind of get the stock market back on its feet within a matter of 2 years. During this time, in 1987, Alan Greenspan, who is the same position as current Federal Chair Powell, kind of had an approach where he asked the banks, or somehow made it more attractive to the banks, to keep lending out more money. And what this did was it allowed banks, or it allowed companies to remain liquid. And of course, this prevented a recession. This, though, unfortunately may have set precedent to what people are assuming or are calling investing with moral hazard, meaning that just because one single player screws up the whole market, the Fed or the government will come in and save all the players who are playing in the market, which is kind of what happened in 2008. Enter the stock market crash of 2007 and the great credit crisis and mortgage crisis that led to the Great Recession from 2007 to 2009. During this time, from 2007 to 2009, the Dow Jones Industrial Average lost over 50% of its value and didn't recover till around 2013. So how did this happen? 25-year Wall Street veteran and author Michael Panzer has said the real reason behind the sell-off include the bursting of history's biggest housing bubble, which triggered a shockwave of wealth destruction that has wreaked widespread havoc through the economy, as well as the unraveling of a multi-trillion-dollar financial house of cards built on greed, ignorance, and fraud. So why did this take so long? I mean, the recovery took 2 years in the 1987 when didn't they learn anything? This crisis unfortunately shook the investor and everyday people like you and me to its core when we find out how shady these financial institutions can be. In addition, the response by Washington and the president wasn't that good in handling what the core causes were. So we're on our fourth crash, and that's going to be the most recent in memory, and that's the COVID-19 2020 stock market crash. This one happened in February and March, and it quickly recovered, as we can all remember, because it happened not too long ago. From the period between February 12th and March 23rd, the Dow Jones Industrial Average lost about 37% of its value. So what caused it? Well, in 2019, many people were worried about the inversion of the yield curve. Do you guys remember that? Well, between May and October, the yield curve inverted. And between January and March, the yield curve was going to invert yet again. But what happened in February? So in February, cases of COVID-19 were said to be spreading outside of China, which put a lot of stress on investors because in the beginning, we thought COVID-19 was a very, very isolated disease by just one area of the map, China, particularly in the Wuhan area, and that wasn't coming to be the case. In addition, we were told not to worry. But due to the government's quick response in signing the CARES Act and the promise of more capital, more money to everyone to stay at home and be unemployed, the stock market rallied back. And remember now, this video is not an economic video, so just because we're still living in like COVID problems, supply chain problems, inflation, stock market, up until this point anyway, in 2021, I'm recording this video in 2022 though, in 2021, the stock market did recover. In fact, by the August or so of 2020, the stock market reached or recaptured its February highs. So what is the current red in the market telling us about our economy, about the stock market, about business, about the US? Well, much of this red and much of this scare is being caused by the Fed saying they're going to tighten their policy. So what the Fed's doing is they're actually taking money out of the system. And how did they do that? Well, instead of buying mortgage-backed securities, buying treasuries, buying all these things, they are going to be selling them. And what that effectively does is it lowers the amount of free circulating money, and by raising the interest rates on their federal funds rate, which raises the interest rates for pretty much everything else, they're making it more expensive to borrow. So all assets that are either speculative or in the growth phase of their development are going to hurt because number one, they need loans to survive. In addition, a lot of the more speculative assets have leverage behind them. So when they sell off, many people have what's called margin calls, where they have to liquidate their position, thus pushing the price lower. So is this a buy the dip opportunity? Only time will tell. What I can tell you is that the economic factors tend to lay themselves in hindsight more so than when we're looking at them in the current time. What I mean by that is that even though all the cards can be lined up for the stock market to make a fabulous recovery today, may not be the same when we look back at it in 1 year. So with that said, invest with purpose. Remember to dollar cost average in if you're investing in the market. That way you can smooth out any of these rough patches and always participate in the market. If market's not for you and you're looking for something else, something new, BlockFi is offering $250 to anyone who uses the link down below and opens a BlockFi account, and you can get some free Bitcoin. Remember to enjoy the journey, and I'll see you all in the next video.